In part 1, you learned how to understand a business, what it does, how it earns, and how it defends its profits. But the deeper you go, the more you realize analysis isn't just about numbers, it's about character. The best investors in the world, from Buffett to Munger, from Rakesh Jhunjhunwala to Peter Lynch, never fell in love with stocks. They fell in love with businesses run by extraordinary people, because you can't calculate integrity on Excel, but you can sense it if you know what to look for. Welcome to part 2 of this journey, where we go beyond spreadsheets into the human side of investing. A company's financials tell you what it has done, but its management and culture tell you what it will do next. And that difference between history and destiny is where most investors lose money. Because businesses don't fail because of technology, they fail because of people. You can copy a product, you can replicate an idea, but you cannot clone character. Every great business you admire, Infosys, HDFC, Apple, Berkshire Hathaway, shares one invisible asset on its balance sheet: trust, one transparency, the mirror test. When times are good, every company looks honest. The real test begins in crisis. Do they hide behind jargon, or do they face the truth? Example: Infosys, after a leadership scandal in 2017, didn't bury the issue. It addressed it publicly, restructured, and emerged stronger. The wealthy don't fear bad news. They fear leadership that pretends nothing's wrong. Transparency doesn't mean perfection. It means accountability. 2. Capital allocation, the honesty of numbers. The way a company spends money reveals its values. Ask, are profits being reinvested to grow the core business or wasted on vanity projects? Are acquisitions strategic or ego-driven? Are dividends stable, sustainable, and fair to shareholders? Example: Asian Paints quietly reinvests profits every year into better supply chains, forecasting tech, and data analytics. No hype, just compounding discipline. 3. Skin in the game, alignment of interests. The best leaders win when you win. Look at promoter shareholding. Is it significant and stable? Pledged shares, red flag. Insider buying or selling, signals of confidence or fear. Example: HDFC Group. Management owns modest stakes but earns through performance-linked pay. Incentives are tied to results, not noise. But when promoters dilute ownership or pledge shares repeatedly, it signals a company losing its soul. 4. Organizational culture, the invisible moat. Culture decides whether a company compounds quietly or collapses chaotically. Example: Apple. Culture of design, precision, and perfectionism. Infosys. Culture of ethics and professionalism. Culture cannot be seen in reports, but it appears in execution consistency. 5. Governance and red flags, the ethics filter. Always read between the lines. Frequent auditor changes. CFO resignations without explanation. Related party transactions not clearly disclosed. Governance doesn't make headlines when it's good, only when it breaks. That's why the wise study it early. Great businesses are built by systems, but great legacies are built by leaders. Valuation is not about numbers. It's about narrative meeting reality. You can find a great company with an ethical management, strong moat, and solid growth. But if you pay too high a price, the business will prosper, yet you won't. Because in investing, price is what you pay, value is what you get. What is valuation really? Valuation is the art of estimating how much a business is truly worth, not in the market's opinion, but in economic truth. The 3 pillars of valuation. 1. Intrinsic value, the real worth beneath the noise. Intrinsic value is the true value of a business based on its future cash flows. It's not what it's trading at today, it's what it's really worth, independent of emotion. Professionals estimate it by projecting future profits and discounting them to today's value. That's the discounted cash flow, DCF method, the gold standard of valuation. But here's the secret. DCF isn't just math, it's judgment. The inputs, growth rate, margins, risk, all depend on your understanding of the business. Example, HDFC Bank, predictable, stable, consistent, easier to value. Zomato, volatile, unprofitable, uncertain, valuation swings wildly. 2. Relative valuation, the art of comparison. Sometimes, instead of calculating absolute value, professionals compare companies to peers. This is where ratios like PE, price to earnings, PB, price to book, and EV/EBITDA come in. They help you ask, how expensive is this company compared to others in the same sector? Is it priced fairly for its quality and growth rate? Example, HDFC Bank trades at a PE of 18-20x. Smaller banks trade at 8-10x. Why? Because the market pays a premium for predictability and governance. 3. Margin of safety, the investor's insurance policy. Even the smartest valuations can be wrong. So professionals always keep a margin of safety, a buffer between price and intrinsic value. Example, if your calculated intrinsic value is 1,000, you'd buy only if the market price is 700 to 800, not 990. That 20–30% gap protects you from human error and market emotion. As Benjamin Graham said, the margin of safety is the difference between investment and speculation. Valuation is both science and art, math guided by maturity. It rewards discipline, not excitement. Intrinsic value reveals truth. Relative valuation gives context. Margin of safety gives peace. When you learn to respect price and value, you stop speculating and start investing. Most investors fall in love with reward. Professionals fall in love with survival. Because wealth is never lost in one bad stock. It's lost in one bad assumption. So let's learn how professionals manage risk, not by fear, but by foresight. 1. The 3 faces of risk. Every business carries 3 kinds of risk, and each needs a different lens. A. Business risk. The core uncertainty. This is the risk of execution failure. Can the company actually deliver what it promises? Look for declining margins despite higher sales, loss of market share, poor product adaptation to new tech, high dependence on a single client or product. Example, Nokia dominated the mobile world but ignored smartphones. The business didn't fail overnight. Innovation did. B. Financial risk, the burden of debt. Numbers may look strong until leverage magnifies pain. Watch for rising debt-to-equity ratio, interest coverage below 3. Negative cash flow despite profit. Example, IL and FS and DHFL both grew fast, borrowed faster, and collapsed under their own weight. C. External risk, the uncontrollable forces. These are risks from the outside world: policy, inflation, technology, war, regulation, or black swan events. COVID-19 wiped out entire sectors overnight: airlines, hotels, cinemas. A single government ban can erase billions in value for crypto or ed-tech firms. Risk cannot be eliminated. It can only be priced and prepared for. 2. Trigger events, the signals professionals watch. Before crises erupt, small cracks appear. Professionals are trained to listen to those cracks. Operational triggers: sudden decline in margins, drop in customer retention, loss of key contracts, inventory buildup. Financial triggers: debt rising faster than revenue, CFO or auditor resignations, delay in quarterly results, frequent equity dilution, sentiment triggers, media hype without profit, unrealistic analyst targets, everyone is buying it euphoria. Example: in 2018, Yes Bank looked unstoppable until the CEO's exit and rising NPAs exposed the truth. 3. The paradox of risk: where opportunity lives. Ironically, the same forces that destroy weak companies make the strong ones legendary. Recessions kill debt-heavy firms but strengthen cash-rich leaders. Policy shocks hurt short-term traders but create entry points for patient investors. Those who bought the fear doubled wealth within 3 years. Every investment is a bet on the future, but the future is never certain. Great investors don't eliminate risk. They respect it, study it, and price it before acting. We've studied the soul of great businesses. We've decoded numbers, moats, leadership, and risk. Now, it's time to assemble it all into a repeatable system. This is your equity research blueprint, the same 10-step process that professional investors, mutual fund analysts, and family offices use every day to identify compounding machines early and hold them with conviction. Step 1. Business clarity. Do I understand it? Before you read any report, ask yourself, can I explain what this company does to a 12-year-old? If not, stop there. Define the product or service in one line. Identify the core customer and the problem it solves. Understand how it makes money: one-time sale, subscription, commission, or recurring revenue. Example: Asian Paints equals predictable consumer business with recurring demand. Step 2. Profit engine. How does it earn? Study the business model and margin structure. Is revenue recurring or cyclical? Are margins stable or shrinking? Is growth driven by pricing power or external expansion? Look for companies with operating margins greater than 10% and consistent ROCE greater than 15%. Step 3. Financial health. Is it built to last? A company's true strength lies in its balance sheet and cash flows. Checklist: debt to equity below 1 operating cash flow greater than and equals to net profit interest. Coverage greater than 3 positive free cash flow. If profits rise but cash shrinks, walk away. Profit is an opinion. Cash is fact. Step 4. Moat strength. Can competitors destroy it? Test for competitive durability. Brand power, distribution, reach. Switching cost. Network effect. Cost advantage. Example: Apple's ecosystem, Asian Paints logistics, and HDFC Bank's process discipline all protect long-term margins. Step 5. Leadership integrity. Who's steering the ship? Study the people, not just the profits. Ask, are they transparent in communication? Are they conservative with capital? Do they have skin in the game? Do their incentives align with shareholders? Step 6. Valuation discipline. Am I paying the right price? Don't chase hype. Estimate worth. Use a mix of intrinsic value, DCF, for stable companies, relative valuation, PE, EV, EBITDA, for sector comparison. Always maintain a margin of safety, 20 to 30%. Step 7. Risk radar. What can go wrong? Study business, financial, and external risks. Ask, what if sales fall 20%? What if a key supplier or customer disappears? Can this company survive 12 months with zero revenue? Diversify intelligently. Don't hedge panic. Hedge probability. Step 8. Growth triggers. What can go right? Look for catalysts that can accelerate growth. New markets or capacity expansions. Policy support, sectoral tailwinds. Product innovation or cost disruption. Example: EV adoption for Tata Motors. AI explosion for NVIDIA. Spotting a trigger early equals buying before the crowd sees it. Step 9. Time horizon. Can I let compounding work? Investing is not trading. It's delayed gratification in action. Hold high-quality businesses for at least 5 to 10 years. Don't interrupt compounding because of market noise. Buffett held Coca-Cola for 35 years. HDFC Bank rewarded patient holders across 25 years. Compounding doesn't reward activity, it rewards consistency. Markets reward intelligence occasionally, but they reward discipline forever. So research like an analyst, invest like an owner, and think like time itself, patient, silent, compounding. If this video gave you clarity, you now owe yourself consistency. Watch previous episode. Decoding Great Businesses. 7 Hidden Traits Every Multibagger Shares. Comment below. Which of these 10 steps changed how you'll analyze companies from now on? Subscribe to @Value over Vanity, where every video teaches what others sell as paid courses.